Hi, thanks so much for tuning in. You're watching Stocks in Focus. This is BQ Prime. My name is Alex Matthew. Let's take a look at where things stand right now. We have gains of about 0.4% for the benchmark Nifty 50. It's holding just below that 18,300 mark in trade today. But we're here to focus on a few stocks. And joining me to talk about them is Gaurang Shah, who is Head Investment Strategist at Geojit Financial Services. Thank you so much, Gaurang, for taking the time, and good morning to you. I think quite a few stocks in our list are earnings related. So let's kick off things with NTPC right off the bat. And I think if we can pull up the numbers, the revenue is up over 19%, and it's ahead of consensus estimates. The PAT number is more or less in line with expectations at 4,871 crore rupees. Margins have contracted just a tad bit. So what's your view on the stock, and should an investor consider a fresh entry at this point?
Thank you very much, Alex, and morning to all of you all, and good to see you in front of new backdrop after a pretty long time. It's great interacting with you once again. So, on NTPC, well, first a disclosure, we do have a buy recommendation on NTPC fundamental side from a long-term point of view, and the margins improvement is going to improve going forward. And that is because of the multiple changes that the government has done for power generating companies. Along with that, Alex, our sense is that power transmission and distribution companies are also likely to do good. So we have and of course, NTPC is one of the largest capacities in terms of power manufacturing, power generation, with great plant load factor. What we have been given to understand, Alex, is that in the next 2 to 3 years, given that the potential of manufacturing is going to go up, given that you have energy usage going up, there is going to be an additional 370 gigawatts new energy producing facilities that is going to come up. Now, that's going to be driven by conventional power generation, hydro. More of it is going to be dependent on solar and wind. And our sense is that that is where companies like NTPC or Torrent Power or Tata Power is going to play a very crucial role. It has been a slow mover, no doubt about that. But I think fortunes for not only power generating companies, but power transmission and distribution companies is also going to change over the next 2 to 3 years. So if you have a longest time horizon, we have a positive view on NTPC.
Fantastic. The stock is up about 1.5%. And a very important point that you raised with regard to the discoms, the fact that their debt has come down quite substantially, and also the payments are now being made on time. JSW Steel is the next counter that we're focusing on, and perhaps you can give us a sense of the results in the context of the overall space. Of course, globally, we're talking about the underlying commodity or the metal prices heading lower now, so that might be a bit of a pressure for the company. But how do you rate the numbers? Net profit up as much as 12%. It's coming significantly higher than expectations at 3,741 crore rupees. Even the revenue is, though it's flat, it's ahead of consensus estimates. How does this rank in terms of your picks in the metal space?
Well, so this also features on the fundamental buy coverage side, JSW Steel. And you're absolutely right, Alex. More than the domestic or local news flows, the entire metal universe is highly dependent on what happens across the globe, especially the news flows that we get from China. In the global arena, you have downward movements as far as flat and long products are concerned. But in the domestic markets, the verbatim given by most of the metal manufacturing company or steel manufacturing companies is that they are expecting a slightly upward move up north, that is, for both flat and long products. Two or three triggers just to highlight, Alex, why we are positive. First of all, government spending on creating infrastructure, Bharat Nirman, as the government has been speaking about. You have dedicated trade corridors, airports, ports, logistic corridors, affordable housing, housing for all, Pradhan Mantri Gramin Sadak Yojana, Pradhan Mantri Gramin Awas Yojana. You have a lot of activity across major tier 2, tier 3 cities and larger cities as far as metros is concerned or monorails are concerned. All these things, you are going to do two things. One is metal and the second one is cement. These are the two basic commodities which will go into creating any kind of infrastructure, especially a durable one. Real estate sector has seen improvement, and a slight positive rub-off effect comes on to metal and cement sector also. So overall, we are positive, but the entire sector, Alex, over the last 2 years has been a very slow mover, not because of domestic or local news flows, but more because of global news flows. So yes, the numbers were slightly better than what we had penciled in, and we expect improvement to come through as we go forward from here on. But you need to have a little bit of conservative return approach in terms of investment. I think.
So, but then can I follow that up to ask you, if you compare the large two, if you're talking about Tata Steel and you're talking about JSW Steel, which should an investor focus on? Or should they divide their approach to both of those companies?
Well, I always been an advocate of distributing your risk across asset classes, whether it is equities, mutual fund, debt instruments, or real estate or gold. So I've been a big, advocate of distributing your wealth into different asset classes, thereby reducing the risk. Similarly, we always advise not to overexpose yourself to a particular sector or a company, because that again creates a little bit of disturbing situation in case if there is some news flow which is not on the positive side. Having said that, at current levels, our first preference will be JSW Steel. Tata Steel will feature somewhere close to about 100 or below 100 in case if there are bad days and if the markets have to go down or the metal sector has to come under pressure because of global news flows. So closer to 100 or sub 100 would be Tata Steel, but at current levels it would be JSW Steel. But yes, I would distribute, suppose if I had a rupee to invest, then 50% will go into JSW Steel at current levels, and closer to 100 or below 100, 50% balance will go into Tata Steel.
Okay, we're not too far away from that mark for Tata Steel. It is currently trading at just under 105 rupees. So watch out for that one. Glenmark Pharma is the next one, Gaurang, and a disappointment. And I think more often recently we're hearing news about observations from the US FDA, and that specter seems to be coming up more often in the recent past. And the numbers kind of reflect that net loss as opposed to a consensus estimate of 276 crore profit. The net loss is as high as 428 crore rupees. And that relates to a settlement that they had to do. The revenue also is more or less in line with expectations, but that's a red flag and a negative. So how do you take that news flow? And not just on Glenmark Pharma, what should the approach to pharma be? Because pharma has been under pressure.
So let me speak first about the second aspect of your question, that is the pharmaceutical sector. So as we all know, Alex, post-COVID, and of course, after that, almost about a year and a half, we had a fantastic outperformance from the entire pharma universe. Let me say this, Alex, even during that time, when the going was good for the pharmaceutical companies, there were three names which stood on the negative side. One of them is, of course, Glenmark Pharma. Second one is Biocon, and third one is Lupin. All these three names, even when the going was good for the pharmaceutical sector, has kind of performed, and they continue to underperform. So our view at Geojit on the pharmaceutical sector is that at best it is going to be a flat to a neutral performer because of the positive news flow on COVID and recovery, etc., etc. Even the World Health Organization has now declared that whatever serious impact as far as the pandemic was concerned is now a history. And there have been restrictions getting lifted off in various countries, depending upon what the situation is. Having said that, there could be three names which would outperform the pharmaceutical sector or the pharma index. And those three names are Dr. Reddy's, Divi's Laboratories, and Sun Pharmaceutical, along with Cipla. We do have a positive coverage on Glenmark Pharma. We are waiting for a little bit of more clarification on the fundamental side. But in terms of preference, I think four names that I mentioned would be top priority, followed by some select other names.
Let's shift gears and talk about Zomato. So it has had an EBITDA loss of 225.4 crore. That's lower than the consensus estimates, and the net loss also lower than consensus estimates. And within that is the overarching conversation about whether or not they're going to be able to make money consistently with the challenges posed by ONDC, etc., right? So what would you say about the results, one, and about buying into Zomato and holding it for the long term?
So again, first a disclosure, Alex. I think it's prudent on my part to do that. We have a coverage on Zomato. on the fundamental side. Even during the IPO, we had come out with an IPO note. And I think the IPO floor was at about 65, correct me if I'm wrong. My memory serves me right. And then the stock went up to, I think, 140, 150.
Yes.
And then again corrected quite sharply below the IPO floor price. The problem with the new age company was valuation, not only Zomato, but you take for in case Nykaa or Paytm. I think all of them have got their own story to tell us in terms of the rich valuation, extraordinary listing, and then the fall off the cliff. Zomato, well, I think first of all, ONDC, that is Open Network for Digital Commerce, it will play a very crucial role. I am not denying that, but it will take a while for it to catch up. Till then, I think the subscriber base is going to increase, and people like you and me are going to possibly opt for platforms like Zomato or Swiggy or any other e-commerce platform which we get attracted to and keep on ordering. Scalability is something that is very important. So I think only time will tell us, Alex. Little bit difficult to make any futuristic judgments or statements. But if scalability is there and if opportunity is there, then definitely you will have subscribers switching over from one to another. And India is always a country where people want to experience and explore new digital platforms. How secure they are or not, that is something, again, future will tell us. But yes, opportunity is there. And we believe that the numbers that the company has come out with, I remember during the IPO time, the management made a statement that over the next couple of quarters, they expected to, break even, come in black, and then possibly in green. So it will take some time because it's a highly competitive business. And now with Open Network for Digital Commerce coming in, I think it may stretch a little bit longer, but we remain positive on Zomato.
Speaking of food delivery, I keep telling myself that I shouldn't, and I'm waiting for food as we speak. But Cochin Shipyard is the next counter that we're talking about, and earnings here, again, a bit of a disappointment from what I see, at least, prima facie on the numbers. Net profit down about 85.67%, 39.34 crore rupees. The consensus estimate had pegged it at 128 crore rupees. So a significant underperformance, miss on the revenue front as well. They've come in at 600 crore for the quarter, and they were expected to have posted around 802 crore rupees. Is it simply a question of a lean quarter, or is there a more long-term issue that you need to bear in mind?
So, Alex, first of all, we have a buy coverage on Cochin Shipyard. And during the IPO, which hit the market a couple of years back, we had a subscribe recommendation on Cochin Shipyard. I have been to Cochin. I have not seen the facility from inside, but outside, whatever I have seen, it's a humongous facility as far as Cochin Shipyard is concerned, especially for ship repair and new ship building. It's got one of the largest dry dock facility in Asia, if I'm not mistaken. The recently commissioned aircraft carrier, INS Vikrant, 75% is indigenously made by Cochin Shipyard using indigenized equipments, and it was a task which was of a very tall order. After that, they've got a lot of other new orders for the Indian Navy. Along with that, from private players as far as vessels are concerned, both dry as well as bulk carriers. Repairs are also a significant part of the revenues for Cochin Shipyard. And whenever you look at a company from a defense perspective, let me say this absolutely clearly for the benefit of your viewers, you should not look at quarter on quarter because that is not the right way to map the growth of defense-related companies. Point number one. Point number two, all these companies which are associated with defense, they take very long time to make a particular product, get it approvals from various authorities and regulators, and then commission it or get into mass scale production. And all this thing is highly dependent upon technology also, Alex. One must bear this in mind. So you need to have at least 2.5 year plus kind of time horizon if you really want to have a meaningful return from your investments into defense-related sectors. So I think quarter on quarter, gauging a defense company like Cochin Shipyard will not be a right approach.
No, fair enough. And you can't build a ship overnight or repair it for that matter. Okay, let's move to the last one. And that arguably is the stock of the day from the list that we have today. And that is from the healthcare space. Narayana Hrudayalai. I struggle with this name. Narayana Hrudayalai. I'm going to ask you to say it instead. But
that is Narayan Hrudayalaya.
Yes. Okay. You say it much better than me. I'm going to get you to say it next time. I'll just message you. All right. But the PAT is up about 1.5 times. The revenue is also ahead of expectations. So what do you say about this particular counter? The stock is up as much as 7% in trade today.
So we have a buy coverage over here. Along with Narayan Hrudayalaya, we have a positive coverage on Apollo Hospital. So these are the two healthcare related entities that we are extremely positive on. I think it had a very humble beginning after the IPO. It was absolutely in a range. And then, of course, the street realized the kind of efforts and the work that this healthcare-related entity, Narayan Hrudayalaya, is into. And the person behind this entire growth story, of course, we all know about him. Having said that, given the uptick that we are witnessing, I would not advise to make any new investments at current level. But when you get a dip, I think it will be a great opportunity to start accumulating the stock and invest from a long-term point of view. I think both pharma and healthcare are two stories which will go hand in hand because they complement each other, Alex. But healthcare-related, hospital-related entities are likely to do much better compared to the pharma companies, as we spoke a while back.
Fantastic. So I'm going to go and practice the name of this company in the meanwhile. Thank you so much, Gaurang, for taking the time. Pleasure speaking with you always.
Always an honor. Thank you, Alex.
Viewers, do stay tuned. Lots more coming up in just a bit on BQ Prime.